So give us your take on what the markets went through, because we did have the geopolitics at the beginning and the end, and then we had a fair amount of speculation about the Fed in between.
Well, there was some mixture. I agree with that. I do think the geopolitics kind of resolved itself with Israel taking a somewhat modest approach to retaliation to the Iran attack. I think the bigger issue is the combination of how people perceive the Fed's behavior and what the Fed will do over the course of the year, and how that interplays with the valuations in the marketplace. Coming into the year, as was true last year, people were quite optimistic that the Fed was going to cut rates. Inflation data actually early in the year looked like it was benign and actually getting better, and then it got strong. And then the Fed said, no, I'm not going to cut rates, and the market ultimately was very unhappy about that. And so what I think we're seeing is people reassessing their positions as a result of the Fed saying, I'm not going to cut rates. There's also a scenario that people believe could be happening, that if the Fed doesn't cut rates, and in fact, companies are reporting weaker earnings, then the Fed may be behind the curve and could create a recession. And that's also causing people to take off risk at the present time. And that may be some of what we see in the tech world.
The Fed says, at least, it's concentrated on full employment and inflation, period. Not so much worrying about what happens to corporations and the consequences of that. Do we believe them? I mean, they haven't been too concerned about loosening financial conditions.
I think right now the economy is relatively strong. And it's actually in the numbers. And I think the Fed, when the economy is strong, actually sticks to those two principles. If the economy were really weak, then they would start worrying about the impact that corporations might have on the overall economy if, in fact, they started laying off workers, and if, in fact, they had defaults on their securities, and we had real chaos in the market, and the equity market then would go down dramatically. And then I think the Fed would start paying attention to that indicator as well. But when the market and the economy is relatively strong, the Fed's going to stick to its two principles.
The value of equities, as I understand, is basically a discounted future cash flow, what you expect
generally
to get. And that it's important what the discount rate is. So if the interest rate's higher, that means the stock value today is lower, particularly with some of the stocks that are expecting it in the out years, not having it right away. Is that a simple explanation of what may be going on right now, that we were going too far, too fast with the equity valuations?
Well, it's certainly part of the explanation, but I think it's maybe a little bit too one side, one indicator, one dimensional. Thank you, one dimensional. I think what we're seeing is more sophisticated than that, or more nuanced than that. I think that earnings are going to go up. The market is reflecting a relatively strong economy. The multiples at which stocks trade, which is related to the discount rate, that may be under pressure a bit. Remember, we had a pretty fast increase in stock prices at the beginning of the year. S&P was up 10%, NASDAQ was up 12 or 13%. Even the Dow, which was lagging, was up 5 or 6% in a short period of time. And that's usually what you get for a whole year. So I think that investors are taking a breather effectively, and they're reacting to this lack of Fed enthusiasm for cutting rates. There's also another question of what does the yield curve shape look like? You know, the yield curve shape has been inverted for a very long period of time relative to history. That creates capital allocation that is not efficient, because when you have interest rates in the short end that are higher than interest rates in the long end, investors then don't take risk. In fact, they're piling into shorter rates because they're more attractive than longer rates. That has a tendency to effectively retard economic growth. That's the main point of the Fed actually having an inverted yield curve. But they can't keep it like that forever. So at some point, the Fed is going to cut, and we'll come back to a normal yield curve.
When you talk about investors taking a breather, are they taking a breather right now, as far as we know, in big tech? Because big tech have been on such a run for so long, and then this week it looked like it was getting a little wobbly, whether it was NVIDIA or Netflix, or you can name it.
NVIDIA is a little bit of an interesting case, because NVIDIA actually had a very significant increase in its stock price at the beginning of the year, but not driven by multiple expansion, driven by earnings increases. That's actually important, because its decline is not driven by multiple expansion. It's driven by multiple compression. So here you had constant multiple increase in earnings, then you get to a peak, and now the stock prices come down because the multiple has gone down. That may be indicative of it taking a rest as opposed to it's breaking down. the interest rate discounting function that you spoke about, that actually could be having a bigger effect on longer-term growth stocks where their growth isn't changing, but people are now perceiving the interest rates are going to be higher for longer, and that could be affecting tech valuations.
So if you were an investor to make decisions based on this week, which I know you never do, but if you had to do that, would you say pull the horns in a little bit? This is a time to take a little risk off?
I wouldn't. I actually wouldn't. You know, equity values since the end of 21 are actually not up very much at all. The compound growth rate is less than 5%, maybe 2%. At any period of time being 5 to 7 years, equities go up.
Right.
We're actually getting an opportunity to buy here. I know it doesn't feel that way. Yeah. And you know, I know when things are difficult, people are like, well, it's time to take money off the table. But actually, I don't think that's true.